What is a BDC? In its simplest form, a BDC is an investment fund structure. More specifically, it's a 40-act fund that lends to private companies. The characterization of BDCs can be broken down into three components. First, a BDC is a lender. It raises capital from institutional and retail investors and lends or invests that capital into private companies. Second, a BDC is an SEC-registered fund, meaning it files quarterly financials and operates with a very high degree of transparency in terms of everything that it owns. In other words, what you see is very much what you get. And third, a BDC is a dividend payer. BDCs are required to distribute roughly 90% of their investment earnings to shareholders in the form of a dividend. This is reported on a 1099 rather than a K1. Why might investors want to consider BDCs? BDCs are essentially vehicles that provide access to the private credit asset class. And there are three key reasons investors tend to focus on this industry. One is diversification. The directly originated corporate loans found in BDC portfolios tend to generate returns that are less correlated with traditional stock and bond portfolios. This low correlation, coupled with the historically low volatility of the private credit asset class, offers an opportunity for investors to increase portfolio returns without increasing risk. Another is dividends. BDCs pay their returns in the form of a cash 1099 ordinary dividend, and many investors value that quarterly or monthly payment as part of their investment portfolio. And a final reason many investors turn to BDCs is the potential for downside protection. BDCs generally focus on the very top first lien portion of the capital structure, which can limit downside given the significant first loss protection below first lien lenders. And of course, BDC portfolios generally consist of floating rate loans, meaning they can serve as a natural hedge against inflation and higher rates. How can investors access BDCs? There are a few different types of BDC structures, and Barings operates all three of them. The key difference between the three structures is liquidity. A public BDC is a BDC that trades on a public stock exchange. Public BDCs can offer investors meaningful liquidity, but they also come with a high level of investment volatility because publicly traded stocks move up or down with the markets. Private BDCs are another type of structure. Private BDCs resemble a drawdown structure where an investor makes a commitment and that investment is drawn down like a private fund. This structure tends to offer lower investment volatility than a public BDC because it's not affected by the technical movement of the stock market. But there is limited liquidity as investors have limited to no ability to sell shares. And then finally, there are perpetual BDCs. A perpetual BDC is a fund structure that allows investors to subscribe monthly and access liquidity quarterly at net asset value through a repurchase program. The perpetual BDC structure allows investors to deploy capital day one into a fully ramped, fully diversified, seasoned portfolio with no J-curve impact. Perpetual BDCs also generally pay a monthly dividend. What we often see is that many investors are drawn to the perpetual BDC structure as they appreciate the benefit of a structure that allows liquidity at net asset value and does not directly follow the technical moves of public equity markets.